the idea here is to give you a short outlook on where the capital went last year on the hospitality market across countries and across the world, and hopefully help you drive help your allocation for next year, and give you a few hints and a little bit of food for thought, so that you can maybe increase your allocation for and towards our beautiful asset class. So let's start with global transactions. As you can see, 66 billions of dollars were invested last year on the hospitality sector. It's a pretty healthy year. A little bit of an increase vs 2017, even though limited. And what is interesting is that we think this year is going to be pretty flattish, but unfortunately for Europe, we think that the level of transactions in EMEA will decrease this year. And this is not due to the fact that investors are less interested in acquiring hotels in Europe. This is due to the fact that there is a very low supply. I mean, there is a real scarcity of hotels on the market at the moment. So we're struggling at JLL to try to convince owners to put more on the market, because we think there is a lot of frustrated capital on this market. We noticed this when we marketed very recently the Jessina portfolio. There was a lot of interest for this portfolio, and across Europe, every time we have a nice portfolio in key cities, there is a lot of capital looking at it, and unfortunately, most of them are pretty frustrated. So that's the first thing I want to raise here. If you have hotels to sell, that's the time. If we look, I mean, here in this graph, we see that North America and Europe are the only two continents that attract more capitals than they export, which is, I think, and if you look at, this is interesting to see here, if you look at Asia, Pacific, and China, they export more capital than they import, and we think this is something that is going to change soon. That's the reason why we think that, as I showed here, the level of transaction will increase in these markets. And some capital will, I mean, this is not due to the fact that European investors will invest in Asia. This is due to the fact that these Asian investors will invest more domestically and probably less in Europe because they have nothing to buy. So let's focus on EMEA. Here to the right is the ranking of last year. As usual, United Kingdom is on the first position, but Spain is very close. There was a lot of transaction last year in Spain. We'll get back to it later. Again, this is a pretty healthy year, and first quarter is a bit lower. So we don't expect, as I said before, an increase. So let's look at who bought. So we can see here that this is investments in Europe are pretty domestic actually. We have a lot of domestic buyers, 44%, and we also have, it's pretty EU-centric, so meaning that 70% of investments were made by European players, which is a bit, but you notice it's a bit lower than before. So we see that Northern American capital is coming. We see a lot of interest. We saw funds like Angelo Gordon that raised a lot of equity recently, and that are willing to invest. We saw Colony Capital investing also in the Maranata portfolio. So there is a lot of interest from American buyers. What we see also here, what is interesting to see, is that the weight of Asian, excluding China and by the way, including China, is decreasing. We expected it to grow when back in 2013 we thought they would reach maybe 20%. But what we noticed is that actually the Asian buyers, they are not so much interested into hotel properties. They will focus more on equity. So we saw them buying shares in the largest hotel operators, such as, for instance, we saw Minor Hotels recently, a Thai fund, taking a 94% stake in NH. We saw also HNA that owns 25% of Hilton. They also bought Carlson Residor last year. We have Jinjiang owning Louvre Hotel, and they also took a 12.3% share in Accor. And another example would be Fosun that owns Club Med. So you see that these guys, they will focus more on equity, and which makes us think that probably, and we'll talk about it later, because this is not only on our sector that these things happen. So they take stakes in most of the European and American companies. So the question we can ask to the real estate community is what's going to happen with our head offices in 10 years from now? Where are they going to be? Are they still going to be in Paris, in London, in Frankfurt? Or are they going to move to China? So that's a question you should ask yourself when you think of your allocation. Now, who is buying? So who is buying? You see a lot of appetite from private equity. So more than 2017, 44%, which is very good for us because it means that these guys are short-term holders. So it means that they will sell in 5 years from now, which is very positive because I think there is a lack of liquidity on the European market, especially on the French ones. Most of the assets are owned by very long-term buyers, either sovereign funds or REITs or private individuals, so which doesn't give much space to the investment community. If we look at supply now, as you can see, Paris is still, the existing supply in Paris is 50% the one you have in London, and there is a very limited pipeline. So it means if you are a developer, please feel free to build hotels in Paris outskirts. There is room for more, definitely. What is interesting to see here also is Frankfurt, where we see a very, very strong pipeline. So that's maybe a question we can ask to Andreas later. Is this room for as much pipeline? Probably because most of the developers are expecting to benefit from the Brexit and having more companies relocating to Frankfurt. So that's why they started building so much. But let's be careful with Frankfurt. And also it's interesting to see the pipeline in Dublin is amazing. So again here, maybe I would be careful in building more in Dublin. So let's focus on the big four now. So France, Germany, UK, Spain. So what is interesting to see here in Germany is a slight decrease in the levels of transaction. The market was, if you look at the transaction one by one, mostly single assets traded, and there was no very large transaction. I think the larger transaction that we recorded was the sale of the Leonardo hotel in Munich for 157 million euros, bought by Invesco. And then if you look at the transaction, it's mostly between 50 and 100 million, but it's everywhere in Germany. So mostly the five main cities, but you see a lot of secondary cities as well now in our league, in our data. So this is interesting to see that investors and mostly institutional investors are now looking for to diversify in secondary cities in this market. If you look at the UK, I think the UK is very different. Was very different last year. You see a lot of portfolio deals. You see 51.9%, but this is actually two large portfolios that were transacted. There was the Principal Hotel portfolio bought by Covivio to start with. What is interesting here is that they managed to secure a lease agreement with Intercontinental, which was really surprising, and they are really proud of it. And hopefully they can do it in other jurisdictions as well. And the second large portfolio was Project Ribbon, bought by the Dion family. So that's high net worth individuals that bought this portfolio. And now if you look at, I will get back to France later, so I don't want to focus here on France. If you look at Spain, the amount invested was amazing last year. It was mostly driven by the Blackstone acquisition of Hispania Hotel. So Blackstone is now the largest hotel owner in Spain with 13,000 keys. And this shows the attractivity of Spain for private equity. That's not something new. I mean, over the past 3 years, we saw a lot of private equity investing in Spain. because the market, there were a lot of distressed assets on the market that suffered from a very high financing leverage, because most of these were built by developers at the end of the 90s that thought that they end that with very, very high leverage, and that thought that the market will keep on booming, which was not really the case, even though the performance is improved because of the attacks everywhere and in the world. And so a lot of tourists started going back to Spain, which also helped improve the performance. So that was like a perfect alignment of planets. So high performance, a lot of distressed and cheap debt to acquire. I mean, and that's why private equity started investing in Spain very large amounts, which is very positive for Spain. So the market now is very transparent, is very liquid, and we hope that will continue. But we expect, I think, the trend to the level of transaction to decrease a bit next year, because most of the deals are down now, and these guys, they tend to hold for 5 to 7 years. So I don't think they will trade in the short term, but you never know, because they are pretty opportunistic. So if institutional buyers with the low cost of capital come and offer the good price, they can always sell. Let's look now at operating structures. So I guess you're pretty familiar with these, but it's always good to remind it. So you can go with leases agreements. So this is what institutional clients like, such as Union and Amundi and AEW, AXA. That are the ones that we see the most on our European market. But which is interesting to see here is we see more and more management contracts, but I think we should see more. So that's something we try to push at JLL. We try to convince institutional clients to look at management contracts with what we call reversed management contracts, meaning that the staff is not with the owner, is with the operator. So I know operators don't really like it, but I think that's the only way we can change this market, especially in France, where everyone is looking for a lease, and all operators don't want to take leases. So the market is kind of blocked. So what we try to show investors that the risk is very limited, that we have the right contracts in place for this. I mean, Amundi did it, Predica did it, AXA did it. I mean, it's not something that these guys, they are pretty risk averse. They are not like, they don't really tend to take high risks. So if they did it, why don't you do it? That's what we try to convince people about. So we'll be happy to explain to you in more details how it works, but it's no rocket science here. So of course here you have a lot of ability to influence the operations if you have a management contracts, even though the manager does most of the job. So you basically write checks, but you can challenge the budget, you can challenge a lot of things in the operation of the hotels, and you have your word to say, and you can really help return go high if you have the right operator, of course. We also see more and more private equities going for franchise, and even some of them running hotels independently without a brand. So we saw, for instance, Vimbert Capital that is doing a development in Issy-les-Moulineaux with a franchise. And we see now in the latest deal we did with JLL, we saw our current buyers, they are looking at getting rid of the franchise and operating without a brand in Paris, because they think that's where the value is for them, and they don't think that paying a fee in the center of Paris makes sense. So we see more and more of this strategy. I don't know if they are gonna be successful with this strategy, but we see more and more of this. So the type of contracts, we see that Germany is mostly a lease market, nothing new here. What is interesting to see is that the structure of the market between France and UK is pretty similar, even though here we made a distinction between, there is 90% of unknown, but the unknown I would classify them at VP. So you can see here that the structure is more similar, meaning that that's the reason why we have more private equity buying in these markets. In Spain, it's a bit different. Most of the hotels are not really classified, so we assume it's going to be a vacant position. So the market is there are not actually many brands on the market. So this is changing. There are small brands, family operated, family owned, but we don't really classify them as brands. So this is a pretty tricky market, and it's, I think if we look at this graph in 5 years from now, it's going to look pretty different. Regarding developments, we see that France is pretty active. There are a lot of developments going on. The most of them, the most recent one and the most visible one is probably the Morlan Mixité project with the Sofitel and France Hostel, which is being built now. There were a lot of projects around Paris on the périphérique. We also saw a lot of projects in Bordeaux, and now in Nice, near the airport, and also in the city center. These are the key markets where we saw a lot of developments. And as you can see, the number of developments and the share of developments in the total transaction is much higher in France than it is in the rest of the big four markets. Probably because we have very strong developers in France, and we have a clear lack of supply, especially in Paris, and because also our institutional community here, and especially the asset managers, the life insurance company that are very active on this market, they tend to like to invest in what we call the VEFA, or forward funding. So now about the trends of RevPar. As you can see, it's very Paris recovered from the attacks, so the RevPar is back to 140 euros. It's even just a bit higher than it was in 2014. So the crisis is behind us. If you look at regions, this is very interesting to see that actually there was very little volatility during the crisis. And it's also interesting to see the spread between Paris and regional RevPar, which means that we believe there is room for an increase in RevPar in key regional cities in France. And we believe that the investment community should focus more on these cities, because the supply is the quality of the hotels down there now is very poor. There is a lot of investments and capex to be done in most of these properties, and so there is room for a lot of for capital gain on this strategy, because you can both improve your EBITDA by doing some nice asset management and also doing capex and hopefully get out with a pretty nice capital gain on this. What is interesting to see here as well is if you look at, of course, luxury segment is more volatile. This you know already, but it's also due to the fact that most of the supply is in Paris. So that's the reason. But if you look at the volatility, and if you look at the volatility of Paris, you notice that, it's not that terrible. And probably the 4-star segment, 5-star segment, was pretty resilient, even though the Palace suffered a lot. We saw pretty resilient 5-star segment in Paris. And again, but you know that budget and economy hotels are very resilient. What is interesting to see here is that the mid-scale, the average rate on the mid-scale segment is going up, which is very surprising, because I don't know if you remember, but 5 years from now, I was at Accor at that time, and we were really wondering what would happen with Novotel and Mercure, and people had doubts about the sustainability of the mid-scale segment. We saw a lot of economy products coming, like Motel One. We saw palaces opening, but we were wondering, so are people going to look for mid-scale products in 5 years from now? And yes, they do. Yes, they do. They want services. They want to be welcome. They want to have a nice room. So yeah, there is room for mid-scale products. It's just a matter of attracting people with large F&B spaces, with large common areas where they can have fun, they can enjoy some good time, they can work, and they can do whatever they please them. But there is clearly and I think this segment suffered less from Airbnb than economy and budget hotels, and that's also the reason why the RevPAR increased when economy and budget hotels, especially the smallest ones, independently owned, really suffered from Airbnb. In terms of RevPAR, so to be brief, we saw a lot of pipeline in Bordeaux, but if you look at the RevPAR, it's still going up. We're pretty pushy on Bordeaux. We think there is still some maybe not room for a lot of development, but we think the RevPAR is not going to stop going up in Bordeaux. Where we are very positive is in Nice. There is some pipeline going on now. For instance, Maison Albar is going to open soon. Verde is also going to transform one of the ex-post colo. Perseus Capital has a project, Le Couvent des Capucines. So the upscale segment is going to change. There will be new products, and I think Nice really needed it. Also, the municipality did a lot to increase the attractivity of the city. They changed a lot in terms of infrastructure. They did a lot of things with the tram. They cleaned up the city as well. And what they tried to do is to make wealthy people that land at Nice airport stay instead of having them go to Cannes, Saint-Jean-Cap-Ferrat, or Monaco. So we strongly believe there is room for RevPAR increase in Nice, especially on the upscale segment. And also we see a lot of developments close to the airports, and we also think that the number of passengers will keep on increasing in Nice. So I think that's really the market where you want to focus in the coming years. We're less positive on Lille. As you can see, the RevPAR is flattening, if not going down, and there is a lot of pipeline coming. So I wouldn't add new rooms in Lille. I would definitely add new rooms in Lyon, and I think even though we're going to see what's the Intercon is going to do, because it opened last week. We're going to see if there is room for more upscale properties in Lyon, and where the prices can go, because that's really a question. Because we noticed, for instance, that in Nantes, where the prices are going up and the RevPAR is going up, there is clearly a cap. The Radisson, for instance, is suffering a little bit, and there is no room for real upscale properties. There is no elasticity to the demand in Nantes, so we have to be careful on this segment in Nantes. But for the rest, Nantes is pretty healthy. And I would say the same for Toulouse. We'll see what the Mama Shelter is going to do, but I think there is also a room for RevPAR increase in this city. So what I want to talk about here is more what we think of the investment market in France and in Paris, and where we think you guys should look. I mean, if you look at the level of transactions, 1.8 billion last year, it's a very ridiculous amount if you compare it to real estate globally, which amounted at 30 billion. So I let you do the math, but 1.8 out of 30 is not much. If you look at logistics and warehouses, the amount of transactions was at 2.7. So it's not double, but it's not far. So you wonder why would people invest in warehouses? It makes sense, because if you take a step back and look at the macro trends, what's happening? I mean, as we said before, Asian capital is buying European equity. So what's going to happen with our head offices? People, they want flex office. They want to work at home. They don't want to commute 1.5 hours a day. So what's going to happen with our office supply? That's first question. If you look at retail, look at what's happening in the UK. I mean, everything's going down. It's collapsing, but this is also due to the Brexit. But if you look at retail, you look at the share of e-commerce in the turnover of all the main retailers. It's increasing. Of course, there is still going to be showrooms everywhere, so people can touch things and maybe try some of them, but clearly there is not going to be a need for so much retail spaces in Paris and in the main cities. So then what else? Of course, if people want to buy online, they need warehouses. They need where they can store things. So that's the reason why investors started investing in warehouses. It makes total sense. So, but if you think next, what's going next? If you think of emerging markets, the middle class people, there are more and more people that have money to travel. What do they want? Where do they want to go first? They want to go to Paris. Where do they want to go second? They want to enjoy the French lifestyle. They want to go to the Riviera. They want to go to Provence. They want to enjoy, their money. So and this is something you cannot move. France will always be France, and hopefully we don't become an open museum. But if you look at the global trends, that kind of looks like it. So we're going to fight, of course, not to, so that doesn't happen. But if I had money to invest now, I would clearly invest. If I had to work on an allocation, I would think of decreasing my office allocation and maybe my retail allocation, and try to increase my hotel allocation. I think it definitely makes sense if you look at macro trends. But what's the problem here? It's that you don't find anything to buy. So that's where people, I think, we have to do something about it. We have to convince hotel operators to change the way they look at the contracts. We have to convince institutional clients to look at other things, to look at other contracts, and to try to be a bit smarter and to take a little bit of risk. But if you want return tomorrow, if you won't get return without a little bit of risk. But if you look, and if you think closely, if you take a management agreement, your risk is very limited. You have the best-in-class managers operating the hotel for you. So of course there will be a little bit of volatility but you can also secure a minimum guarantees. You can secure a lot of things, and don't worry, you'll be fine. So that's basically my conclusion. But I just wanted to, but you will receive the presentation. I just wanted very briefly to give you 3 potential strategies. If you're an opportunistic buyer, what I recommend to do is to acquire a medium-sized regional platform in France, because you have very high yields. And what you want to do with it is what PAI did with B&B, and look at which price they're selling now, is what Blackstone we did before with Simply, what they are doing now with Hispania in Spain, is to make it grow, to become, and that's also the play of Colony with Maranatha, to make it grow, to become one of the largest white label operators, and eventually to sell to either one of your competitors, one of the largest hotel groups. We see a lot of consolidation on the global markets, or to an institutional investors that will have such a large portfolio to buy. The larger, the lower the yield. That's what we noticed. The larger the transaction is, the lower the yield, because you attract people with a very low cost of capital, but they won't move for 15 million deals. They will move for 2 billion deals. So the larger your portfolio is, the lower cost, the lower your exit yield will be. So that's play number 1. Play number 2 is value add. This is pretty easy. You buy a poorly managed portfolio or hotel in a key location in France. Most of them are privately owned. They have no brands. They have no cluster. They have nothing. So you just do your asset management. I'm not saying it's easy, but it's feasible. You can double your yield and eventually sell at a very low yield to a core buyer. But this will highly depend on how the market will change. Right now there are not many HMA buyers, but that's what we're trying to change. Because if these HMA, if the institutional investors start, I think the key is here. If they start buying HMAs, that will change everything for every other type of investors, because they are basically the exit door to every one of them. And there are also always already opportunities in Paris that we can discuss about hotel management agreements. We still have to discuss with the operators if they agree to take the staff with them, but we'll have a few things to look on the Paris market in the coming weeks. With low yields, that's for sure, but it's still higher than what you get for offices. If you look at the yield you can get for, let's say, 4% in the CBD in Paris, right now if you buy an office, it's going to be 2% or 2.5%. So you'll still have your spread here. Okay, so that's it. Thank you.
Great, thank you.